Hello and welcome to our latest episode of Armbruster Capital Management's Invest Ed vidcast series. I'm Chris Cebula and I'm here with Mark Armbruster. The S&P 500 just had its worst year since 2008, with over $8 trillion in market value lost. And bonds, which under most circumstances offer investors an element of stability for their portfolios, wrapped up their worst year in 180 years. That's right, the worst year for bonds since 1842. However, just recently, inflation appears to be rolling over. Employment remains robust, interest rates have subsided, and stocks have started to rebound off their lows. What do you think, Mark? Has the market bottomed? Can we expect the Fed to reverse course on its interest rate hikes? Are better days ahead for investors?
Perhaps things are improving and will get even better in the near term, but for truly long-term investors, it probably doesn't really matter. There's still a lot of headwinds for stocks and bonds, such as deglobalization, demographics, a staggering level of sovereign debt, a likely secular rise in interest rates, the potential for a second spike in inflation, and not least of all, war. These are not issues that will resolve quickly, and the end result is that investment returns could continue to be quite a bit lower than what we've come to enjoy historically. I can't say with any certainty when the next recession will arrive, but it seems likely that economic growth will slow, and while it's been a fairly rare occurrence historically, a lost decade for the 60% stock and 40% bond portfolio cannot be ruled out.
That's not a great outlook. You listed a number of problems that we will likely face, but really over the long haul, there are two main factors that impact stock and bond market returns: corporate earnings and interest rates.
Right, but unfortunately both point to a challenging environment ahead. We have been in a declining interest rate environment since the 1980s, but that cycle probably ended with the COVID downturn when the 10-year Treasury yield was around 0.5%. This graph is from technical analyst Luis Yamada. It shows that interest rates have historically trended in 25 to 40-year cycles, and it appears we're entering a new upcycle. If we now have rising rates, it will weigh on both stock and bond market returns, perhaps for the next several decades.
Yeah, bonds share an inverse relationship with interest rates, so rising rates mean falling bond prices. But rising rates also impact stock valuations.
Yes, with higher rates, it becomes more expensive for businesses to borrow money to fund operations and growth. That means fewer initiatives will be undertaken, and economic and earnings growth must slow down.
Rising interest rates also impact what investors will pay for stocks, even if growth is constant. Risky investments, such as stocks, are less attractive if satisfactory returns can be earned from higher yields on safer assets. And then we have to consider corporate earnings.
Yes, and investors should have low expectations. Growth has to be slower in the future. Everyone is aware that tech stock growth has been slowing. Just look at the recent job cut announcements by some of the big names in tech as they struggle to achieve or maintain profitability. And that sector has been a significant driver of short-term earnings, which now seems to be reversing. But that's not the real problem. In fact, sector exposure may not be a determining factor at all over the long term. That's the finding from a study called The Level and Persistence of Growth Rates back from 2001. The authors found that from 1951 to 1997, the median corporate earnings growth rate was very close to GDP growth, irrespective of industry exposure. Verdad Research recently extended that study to 2021 using the same methodology and found similar results. So if GDP is the primary driver of corporate earnings, the future may not be so bright. Economists Carmen Reinhart and Ken Rogoff found that economic growth slows when a country's national debt to GDP ratio rises above 90%. Data from World Economics shows a debt to GDP ratio of 114% in the US right now and 240% in Japan. Other developed economies worldwide are also near or above that 90% threshold. And to make matters worse, fiscal policy in much of the developed world is still very expansionary, meaning that debt levels will likely rise even further.
Common sense dictates that there are consequences to too much debt. An individual can only consume so much on credit before that consumption must slow down, and the debt must be repaid.
Ray Dalio, the founder of Bridgewater Associates, points out a similar dynamic at the macroeconomic level in his work. And he notes that during those deleveraging periods when the debt is starting to be repaid, they have historically been painful, such as in the US during the Great Depression, England in the 1950s, Japan in the 1990s, and Spain, Italy, and Greece in the 2010s. All were periods when economic growth declined substantially. Periods of deleveraging when companies, governments, and even households focus on debt reduction almost by definition result in cost cuts, austerity, and slowed growth, weighing on the ability of corporate profits to expand.
That's already not a rosy scenario, but to complicate the situation further, stock market valuations are still at pretty lofty levels when viewed historically. That means further losses cannot be ruled out. Unfortunately, there isn't much that we as investors can do to change these dynamics. but there are certainly ways we can respond.
Yes, while no strategy works in every market environment, deliberate portfolio construction and broader diversification seem to help in these environments.
On the portfolio construction point, factor-based investing seems to offer some relief in lousy market scenarios. Factors include investments focused on value stocks, stocks with strong price momentum, stocks with higher profitability, and others. A study by Dutch asset manager Robeco found that factor exposures within the stock market tend to outperform the overall stock market during periods when the market is weak. This data shows that a diversified factor portfolio performed particularly well during the 1970s and 2000s, when overall stock market returns were anemic. Factor-based investments, particularly the value factor, held up quite well over the past year, and history suggests they could outperform the stock market in the years to come.
Factor investing could add a couple percentage points to the performance of your stock portfolio over time. However, that still leaves the issue of bond returns that don't look too promising if interest rates continue to rise. Bonds have historically offset the risk of the stock market, particularly during nasty stock market downturns. However, 2022 was a year of high and painful correlation between stocks and bonds. So we want to diversify beyond just stocks and bonds. Funds using investments such as managed futures, private lending, private real estate, catastrophe bonds, and others have been quite defensive as stocks and bonds faltered. Looking at managed futures as an example, the Barclays Hedge SG Trend Index was up 27% in 2022. That's even more impressive when you consider that the stock market was down 18% over the same time period. Investing in alternative investments can be tricky since costs can be high, tax impact is often ignored, and lack of liquidity can sometimes be an issue. Nevertheless, there are some very solid funds in the alternative space that offer repeatable methodologies that performed admirably last year.
Unfortunately, bear markets are part of the investment experience. There is no way to avoid them, and trying to sidestep them by timing the market has repeatedly been shown not to work.
It's also expensive to sell out and pay capital gains taxes on many years of built-up growth.
The better approach is to build a portfolio that can weather downturns, but still provide solid long-term returns. Using a mix of globally diversified factor-based stock funds, low-risk bond funds, and truly diversified alternative investments could help if we're right about the future of the economy and capital markets. Thank you for joining us today. Please feel free to reach out with any questions about this or any other investment topic.